Hello everyone and welcome back to Grow with Tony. I'm your host Tony, and as always I am thrilled to have you here with me. Whether you're driving to work, out for a run, or just settling in with a cup of coffee, I appreciate you giving me your most valuable asset, your time. Before we dive in, a critical housekeeping note. Nothing I say today is financial advice. This discussion is for educational purposes only and does not constitute a recommendation to buy or sell any security. FNDF represents a specific investment strategy with different risks than market-cap weighted funds. Past performance is not indicative of future results. Always do your own research. Alright, let's get into it. I want to take you on a mental trip. Let's go to the grocery store. Picture yourself walking down the aisle looking for apples. You see two bins. In the left bin, apples are $2 a pound. In the right bin, the exact same apples are $5 a pound. As a rational shopper, you want value. You'd likely grab from the $2 bin to get the most for your money. But in the stock market, most people don't shop like this. In fact, the default way most of us invest works quite differently. If you are investing in a traditional S&P 500 index fund, or almost any standard market-cap weighted ETF, your portfolio is governed by price. When a company's stock price rises, it automatically takes up a larger percentage of the index. Unlike a rational shopper who seeks value, market cap weighting passively increases your exposure to expensive stocks simply because their prices have risen, not necessarily because their underlying value has increased. This is a structural characteristic of market capitalization weighting, and today we are going to explore this concept. We're going to look at why the industry is built this way, the potential vulnerabilities it creates during bubbles, and then we're going to look at a different methodology. Specifically, we are going to look at an ETF with the ticker symbol FNDF, the Schwab Fundamental International Large Company Index. Important context here, FNDF invests in international stocks only, excluding the US and Canada. It is not a replacement for your US market exposure, but a specific tool for your international allocation. We are going to explore why focusing on fundamentals, the real business numbers, offers a different perspective on valuation. So let's strip this down. How does a normal index fund work? Most standard indexes use market cap. Market cap is simple math, stock price multiplied by the number of shares. The bigger that number, the bigger the slice of the pie that company gets in your portfolio. Now, to be fair, market cap weighting has strong theoretical support. It represents the aggregate market portfolio, essentially the natural outcome of all investors' collective decisions. It is low cost and tax efficient. But there is a potential flaw. Because the weighting is tied to the price, if a stock skyrockets based on hype or speculation, that company becomes a massive part of your portfolio right at the peak. History gives us examples. Let's look at the late 1990s dot-com bubble. Back then, technology stocks were soaring. Companies with little profit were valued at billions. If you held a standard market cap index fund in 1999, your portfolio became heavily weighted in tech stocks simply because they were expensive. You had the most exposure to the sector that was the most overvalued. When the bubble burst, the index suffered because it was overweight in the exact area that crashed. We saw a similar pattern in Japan in the late 1980s. At the peak of their asset bubble, Japan made up nearly 45% of the global stock market index. Market cap weighting linked your exposure to price, leading investors to hold nearly half their global allocation in one country right before it faced a decades-long decline. So is there an alternative approach? Enter the concept of fundamental indexing. This strategy asks, what if we broke the link between stock price and portfolio weight? Instead of looking at market cap, fundamental indexing looks at the economic footprint of the business. How big is the company on Main Street, not just Wall Street? This brings us to FNDF. This ETF uses a different weighting methodology. It determines company size based on three key fundamental metrics. First, adjusted sales. How much revenue is the company actually bringing in? Second, retained operating cash flow. How much cash is the business generating from its actual day-to-day activities? Third, dividends and buybacks. How much cash is the company returning to shareholders? These three metrics, sales, cash flow, and dividends plus buybacks, tell you the economic size of the business. Here is how the mechanism works. During scheduled rebalancing periods, typically quarterly, the fund adjusts its weights based on this latest fundamental data. If a company's stock price has doubled but its sales and cash flow haven't changed, the fund naturally reduces its exposure to that stock. It's not selling because it hates the company, it's rebalancing because the price has outpaced the business fundamentals. Conversely, if a solid company's price drops but its fundamentals remain strong, the fund might increase its weight relative to the market cap index. This process creates a natural value tilt. It reduces exposure to stocks that have become expensive relative to their business metrics and maintains exposure to those that remain fundamentally large. However, you must know that this portfolio still has a very high correlation with the general index, often over 95%. It is not a completely separate asset class that moves in the opposite direction, but rather a different way of weighting the same market. Now I want to clarify something important. Is this just standard value investing? Fundamental indexing is distinct. Traditional active value managers often try to pick cheap stocks, which can lead to buying value traps, companies that are cheap because they are dying or facing structural decline. While fundamental indexing focuses on business size rather than pure cheapness, it is not immune to value traps either. Companies with strong historical fundamentals can still face obsolete business models. No methodology eliminates this risk entirely. We also need to talk about costs because this is a critical detail. FNDF is an active bet against market efficiency, and it comes with a price tag. FNDF has an expense ratio of roughly 0.25%. For comparison, a standard market cap weighted international ETF like VXUS charges just 0.05%. That 0.2% annual difference might sound small, but it compounds significantly over decades. You are paying a premium for this strategy, so the strategy needs to outperform the market plus that fee to make sense. And that brings us to performance. Research on fundamental indexing shows mixed results across market cycles. While some studies show potential outperformance during bubble bursts because the fund holds less of the overvalued assets, the higher fees may offset these benefits over full market cycles. There is no guarantee this approach will outperform market cap weighting in the future. In fact, during raging bull markets led by growth stocks, FNDF will often underperform. This is called tracking error. If you hold this fund, you need to understand that when the market is flying high on speculation, you might feel like you're being left behind. You have to be willing to look different from the crowd. So who is this for? It requires patience and a long-term mindset. If you believe that over the long run, prices eventually return to reflect business fundamentals, then this strategy offers a logical way to weight your portfolio. But you must be comfortable with periods of underperformance and higher fees. We are nearing the end of our time together today. Let's summarize the key takeaways. Lesson number 1: market cap ETFs naturally increase your exposure to stocks as their prices rise. While this reflects the aggregate market, it can leave you overweight in expensive sectors during bubbles. Lesson number 2: FNDF weights companies based on 3 economic metrics: sales, cash flow, and dividends plus buybacks. Lesson number 3: the fund rebalances periodically to align weights with these fundamentals, naturally reducing exposure to stocks that have become expensive relative to their business results. Lesson number 4: this comes at a cost. The expense ratio is higher than standard index funds, and there is no guarantee of outperformance. And finally, lesson number 5: this strategy requires the discipline to handle tracking error. You are making an active choice to deviate from the broad market. Investing is about understanding the trade-offs. FNDF gives you a methodology grounded in economic reality, but it requires you to accept higher costs and different risks. That brings us to the end of today's deep dive. I hope this episode clarified the mechanics behind these 2 different ways of building a portfolio. If you found value in this breakdown, please hit that like button, subscribe, and ring the bell so you don't miss the next episode. And I'd love to hear from you. What other financial concepts or ETFs do you want me to analyze? Drop a comment below. Thank you for trusting me with your time. Keep learning, stay disciplined, and let's keep growing together. I'll see you in the next one.